Hi everybody, just wanted to take a quick moment to show you how you can use the Housing Alerts tool in order to approach your real estate investing more strategically and position yourself for success when you buy property. So what I've done here is I've pulled up the appreciation graphs for two towns. One's a town, one's a city. Bloomington, Indiana, which is the blue line, and Los Angeles, California, which is the red line. And these are both cities that I've lived in, so I thought it might be interesting to have a look at them. And when you look at them, you can just see they both behave very differently. They're vastly different patterns. The blue line, Bloomington, very typical of a Midwest city, very stable, nothing too radical either way. And by contrast, you've got Los Angeles, which is the opposite of that, volatile. Goes a long way down, goes a long way up. And what we're looking at here on the vertical axis we have appreciation rates, and on the horizontal axis we have the year. So in the middle here we have 0%, and as long as the line in the graph is above 0, you have houses going up in value. And even though you have, say you have a line that's ascending here, the rate of appreciation is increasing. Houses are still going up in value when you have a line trending downwards like this. It's just the rate they're going up in value is decreasing. And the opposite of that is when it's below the 0% axis, you have property basically going down in value. And it's the same thing. You have the rate that's going down in value is increasing with a line that's pointing downwards, and for something that's pointing upwards, the rate it's going down in value is decreasing. And it's, as long as it's below that 0 axis, that 0% line, it's going down in value. If it's above, it's going up in value. So what we have here, this graph represents inflation-adjusted annual home price appreciation. The inflation-adjusted aspect of it means here in 1995, a dollar still buys the same as it does in 2007. So it hasn't taken into account inflation, which gives us a clear-eyed view at the information here. And this is very interesting to me because I left California, I left LA in 1995. And joined my wife in Bloomington, Indiana, where she was doing a graduate degree. And I didn't buy anything till 1997, and I bought property for quite a few years. But that first year, everything went really well for me. And looking back here, it's understandable why, because we had an increase in demand and values were going up. And by contrast to that, 1998, mainly 1999, I remember as being a very tough year. It wasn't too hard to buy houses, but when I did buy houses, it's very hard to find tenant buyers. They were very picky, very demanding. I got very little in the way of down payments from people. I had to make a lot of concessions. When people wanted to buy, they always beat me up in price. And it seems like they were in control. It was also very hard to keep people in houses. A lot of options expired without being renewed. And by the end of 2000, I had decided that if things continued the way they were going, it wouldn't be a good situation. Around about this time, I read Jack Welch's autobiography as well. Straight from the Gut, where he outlined his strategy of being one or two in the category and selling businesses in his portfolio that were less than that, and also with employees that were the bottom 20%, he would fire them, basically. So that made a lot of sense to me, so I applied it to my portfolio of properties, and by the time I was done, I'd sold just about everything I had. I got out of the lease option, subject to any situation where I was holding on to property, receiving monthly payments for people. I got rid of them, and from here on I just flipped property, just wholesale flips, optioned houses, and short sale deals where you just immediately turn around and resell, and didn't get involved in anything after that where I was holding on to the property and I was managing it. But if you look at Bloomington, Indiana in this way, if you were a long-term hold investor, the best you can expect for appreciation is 5%. That's when things are good, and it fluctuates. It's not always that. Whereas if you are someone who is investing in property, looking for high returns, you can look at a place like Los Angeles and realize that it's got a time where values are severely depressed, way down, and over a period of 10 years or so, go from being way down, in this case negative 15% annual appreciation, to up here in late 2004 where we've got almost 30% appreciation a year. Where, you know, if you were tracking this information and you were buying property during this period, this is when you would be looking at liquidating just about everything you have, or at least if you were wanting to hold on to them, you'd be 1031 exchanging out of your property here and exchanging into other properties in different states that are down here in their cycle. So this is very useful from an investor's point of view. If you're looking at investing outside your own backyard, you can look at your local market and see how does it behave. What does the annual appreciation do in your local market, and how does it compare with another market where you're not living but you could be investing, in order for you to make the kind of decisions that are going to make you the most money. Positioning yourself for success. If you were in a position to know this kind of thing was going to happen in a market like Los Angeles, you could look for the period where this is happening with the annual home price appreciation. Get ready with all your cash and lines of credit, and then use this period down here to be buying with both hands. And then when we get back and we've got a trend that's solidified, just hold on as the property over time just appreciates and goes up and up and up and up in value, and eventually liquidate. So I hope it's been helpful, and if this looks interesting to you and you'd like to find out more about housing alerts and how you can subscribe, just surf on over to the URL in the next frame. Bye for now.